Thank you, everyone, for joining us. We've got an early summer equipment market update. My name is Andy Campbell, Director of Insights here at Tractor Zoom, and we've got a lot of information I want to try to convey. I've got way more information in all of this than I'll possibly be able to fit into an hour. And so there will be a couple points in here where we've got links for the follow-up material and sign up for a newsletter to ensure that you get that. But let's get started at a high level. One of the things that I wanted to do is just say what we're going to talk about today, all the different categories I'm going to cover. But I also wanted to try to distill this down into hey, I'm going to zone out here after 5 minutes. What do I need to pay attention to? Of all the categories that I looked at today, sorted those out for which ones did I feel were the most risky and which ones seemed to be going strong. So at a high level, here's what I've covered. Row crop tractors, larger ones doing fine. The smaller ones, kind of a mixed bag. Class 8 combines doing well. The larger combines, again, mixed bag, all the way down to like round balers, challenging market, grain carts. And if you followed anything in the farmequipment.com article that I put out, you'll know that that is a super high risk category right now. So I'll have this again at the end, but this is just a quick snapshot that you guys can take and share on to anybody else that hasn't been able to attend here. And also, speaking of not being able to grab everything, like I said, I've got more content today than I'm possibly going to be able to get through. Make sure you follow this QR code if you are not yet on our newsletter. And also, just to save the date for right now, for our next webinar, there's going to be a lot of activity that takes place this summer. You'll see this as we go through some of these categories, that there are shifts happening in the market right now. And I think as the longer sales season takes place this summer, we're going to see some of these pivotal points start to tip. So I'm really excited, obviously, to share with what I have today with you, but also once we get to the end of this summer, I think we're going to see some really pivotal things change. And this is just your chance to save that date right now, so you can be aware of that when it happens. Okay, we have a couple poll questions, and I had a dealer friend reach out to me and say, this would be interesting to get the perspective on of where do you think the bottom of the equipment market is, and let's see if we can execute that one right now. So the majority of people are saying the bottom of this equipment market is going to be here at the end of 26 or into 27. About 60% of people are saying that. Now, a little bit of perspective. So if you remember that 60% are somewhere at the end of 26 to 27, only 15% said it already happened. I'm going to put this to the side. We actually asked this same question exactly a year ago today. And looking through the rearview mirror, it's interesting to see what we were thinking a year ago about the same number of people answering these questions, to where roughly 60% of people then also thought end of 25 into 26. So take it for what you will, that we think it's just around the corner, perhaps. Okay. Now, this one, we're not going to ask a polling questions, but a good friend brought this one up, and I did want to pose it before we got into a lot more of the details within talking about the macro environment down into a category. But it's something good to discuss at your dealership of how do you define your market, and whether it's the market for all the combines that you're potentially selling, or even larger ag tractors. That is it per farm? Is it per acre? Per bushel, perhaps if it's on the combine side, then it needs to be with the throughput. So as input costs continue to rise, does our definition of what is a full market need to also shift? And I think that's going to be different from the dealership to dealership and within the different geographies, but there's no getting around the point that different regions in this country within the farm economy have been stressed with the rising input costs. And I know that there are a lot of farms now that might be sharing planters, sharing combines, or working a little bit more on the custom side, especially as maybe some people age out of the farm, and then the younger generation doesn't necessarily adopt in. That some of these dynamics what this data that I'm going to be showing you might be telling us. Okay, again, high level. A lot of you already know who Tractor Zoom is. We are a marketplace that collects and shares free listings, a valuation platform with Tractor Zoom Pro, and then a sales enablement platform with Anvil Pro. And really, our Tractor Zoom Pro and Anvil Pro daily just get closer and closer and more intertwined to be able to play off each other as data becomes more and more important to dealerships out there. So fast growing, it's been exciting space to play in, and just happy to be here to be able to share this information. Here looking at the net present value, or the not net present value, the net farm income throughout the years. And obviously equipment goes where cash flows. So that'll be a big focus of what we look at. But where exactly is the cash going to flow? One of the important things to be watching for, and this actually just, there's a lot of news that came out about this just today, that I believe it passed the Senate, likely will pass the House. Question whether or not the president will sign it, but it's a popular move that will actually have a farm bill. Now, with the farm bill, I will say that it's going to provide consistency, I think, to the farm equipment market, but not necessarily a boost. That there is not an E15 mandate in here. There's not a payment type of program that there was in the One Big Beautiful Bill prior. But again, it should provide some consistency that our lack of farm bill has not provided for the past 5 years or so. On the Canadian side, there's a lot of structural challenges that are going on in the macro environment most are going to probably suppress equipment sales and just make it more challenging for net farm profitability north of the border. Record stock levels of peas and lentils, trade disruptions that have been going on with China and India, not to mention the massive disruption that the U.S. has provided with tariffs, and that being 60% of Canadian ag exports into the U.S. On the positive side, the cattle herd has actually increased, I believe, from 25 into 26. And that's the first time that that's happened in a number of years, maybe since 2018. And that has not yet happened south of the border in the U.S. And likely won't. So one positive set of news, but still some challenging structural problems north of the border. And regardless of country, the rising input costs are a massive challenge in this. This was put out by the Farm Bureau Federation here just recently. And I think it's good for equipment dealers to keep in perspective because you're competing for dollars that are out there. And especially because equipment can become a discretionary dollar if something is durable. We're going to get into that a little bit later if something can last one more season. A lot of the other inputs cannot, though. And so these might take precedence over equipment, especially with your top soybeans and corn being some big cash crops dominating that rise of input costs. And then one other one just to make apparent and relevant, and I wanted to do this. This is just grain carts here. It's not representative of the entire industry, but in a sense it is, that we've had in the equipment costs, just general retail equipment costs rising year over year. And psychologically, that does add into a farmer's buying decision. Just when they see that price continue to increase, especially when the commodity prices that they're selling have not increased. I went to a soybean association meeting on Monday, and while it was good that equipment did not come up as a challenge for them, in general, input costs was one of the two main topics that we discussed the entire time. And so it plays into the buyer psychology for sure, slows down the sales process, makes some of those sales happen slower. And I think we're seeing that there are sales that are happening in summary this year and this spring, and you'll see that in the data, but it's just not happening at the rate that it has in the past, even though some values might still be strong. But to put a cap on this whole macroeconomic thing, a lot of the things that I talked about are challenging, and they contribute to the ag economic trough that we're in. But in summary, across the nation as a whole, this is put out by the University of Minnesota, that the ag equity position is still extremely strong. And essentially what that means is that there is enough equity to make purchases, even to make capital purchases, even though liquidity might be stretched. And we would have to have land and equipment drop by about 35%, their asset essentially drop by 35%, while also having their revenue drop about 35% to put half of the farms in a kind of a insolvency category here at the top. And so just as a summary of this, that our median farms right now are far from insolvency. That is a good thing. And it's not likely that we'll get there anytime soon, even though we will be challenged. Okay. And I wanted to share this. Again, we're going to share this information out later. I don't expect you to read all these data points, but I wanted to share this because I thought it was a fantastic summary. It was provided by Meridian Agribusiness Advisors. You can check out their stuff at meridianagadvisors.com, but I get a lot of my information from there. Fantastic resource just to stay on top of the ag industry. But like I mentioned, input costs higher, commodity prices we know are lower, and they've been challenging here as of late. Trade uncertainty, it's challenging. There has been some sales here in the U.S. to China, but just of soybeans here most recently, not corn yet, which would be nice. The Farm Bill is good. Biofuel policy kind of waffles back and forth, and really a lot of this is leading to consolidation. And this is that continued consolidation at the bottom is where I wanted to talk about before we went on to the equipment categories. I'm having a lot of conversations with dealers across the country of the challenges of consolidation, the number of farms that they're selling to decreasing, hurts the sales opportunities, obviously. But with any kind of change, I'm seeing some dealerships position themselves well in terms of diversification. And while you might have urbanization coming in, those dealerships that have moved a little bit more towards compact construction, being able to take advantage of some of those shifts. And there can be some bright sides with the downsides. So I just suggest everybody take a look at that as well. That some of these movements we are not going to stop, but just through diversification and long range planning, you can come out on a safer side. Okay, now getting into some equipment specific data points here. Looking at the overall health of the inventory across the country before we start to dive into category level information. I've shown this slide before if you've been to the webinars. Essentially, I like to take a snapshot it's a histogram of all dealership groups across the country broken out by location of how much inventory they're carrying per location. We all know that back in 2024, we're not in a great position carrying too much inventory. And what that looked like on a graph like this was the bubble was far to your right. And you would have, these are essentially millions of dollars on the x-axis there. And you'd have a lot of inventory sitting at dealerships that were in the $8 million, the 14, the $20 million per dealership. And since then, we've been moving back towards the left, less inventory per dealership location. And what this graph specifically here compares with, what did we look like in April of 25 versus this most recent April of 26. April 25 being the yellow, 26 being the gray. And the big structural moves are that we have a lot more dealerships that are carrying $1 million or less per location. That's good. Actually, 40 more dealership groups are doing that. We also have a little bit less that are carrying this $2 to $3 million per location. That's at sideways arrow coming into the side. And then probably the biggest structural change and healthiest for the industry is last year we had a not insignificant amount carrying somewhere between $9 and $14 million, this bubble off to the far right. That has since shifted, and that group is essentially carrying somewhere between $6 to $11 million per location. Still maybe a little bit high for some, but moving in the right direction. I say all this because what we saw is when these were shifted far to the right in 24, a lot of dealerships had no choice but to have fairly significant liquidation auctions that dropped the market, dropped the values pretty quickly. I don't see us in a scenario where that's going to have to happen widespread again this year, like we did a couple summers ago. Okay, But now talking about try not to freak out about certain equipment categories. I do want to get your pulse on what you think is the most concerning equipment categories, and hopefully, my little foreshadowing of my thoughts aren't going to skew your results. So I'm going to launch this next poll, and I want you to list pick three, up to three, of which equipment categories do you feel for your dealership are the most concerning. And you can probably guess already by the last one that what I'm going to show you is these results. And then we're going to compare them to what this collective group thought at this time last year. Uh, Cotton pickers at 6%, headers 18, combines at a 66%, uh, row crop at 26, four-wheel drive high horsepower is at 55, sprayers at 32, planters at 31. Obviously, these are not all adding up to 100 if you know your math. Uh, forage harvesters, anything kind of in that forage division, 23. One person out there with some lawnmowers. Okay. So I won't be able to show these all exactly side by side. We will have this. We'll put it in a blog post and send it out with the newsletter. So again, when that QR code comes up next time, make sure you click on it. Uh, it some similarities that combines were the leader, not nearly as much as they were last year. And I'm going to hit on that a little bit. And I think that fleshes out in the data. High horsepower tractors being the second biggest one. That was not the case last time. It was kind of tied with row crop behind sprayers. I also have some data to back that up. That's one of my bigger concerns out there. Planters dropped significantly, so did sprayers. I concur. Row crop tractors, I have a bit of a mixed bag on that in terms of what I'm seeing. And so some of those I have seen improved. Okay. This will be interesting. Hard to see in this exact screenshot here in comparison to these two, but I'll make a complimentary piece and we will send that out to everybody. Okay. Now, as I go into the specific pieces of equipment, I am going to go through some of them relatively fast. But what I want you to gather is hopefully one or two nuggets about each different category. And the also over encompassing message that I want to provide is that you'll never have all the perfect information, but with holding costs as high as they are, what we've seen work for dealers over the past few years is taking action is better than not taking action. Having better data is better than not having, certainly better than not having any data. And it is even the better data, the more accurate, the more recent data you can have access to, the better decisions you can make and the faster that you move. And so we start to see a correlation with that. And so you'll see that theme come up here time and again. And I'll make sure that I kind of reiterate it, make a note on that. Okay, grain carts. I'm going to hit on this really quickly. If you've seen the study and the analysis that I put out in farmequipment.com, this will obviously sound familiar. If you haven't, farmequipment.com, you can go there and if you're not a member, you can just kind of sign up and you'll see this piece on grain carts. It, I think, illustrates some of the price sensitivity that we're seeing in the market right now for certain pieces of equipment, and it helps explain what's happening in the market with certain pieces of equipment and why not others. So I'll go through at a very high level. Thanks, Kevin, first of all, for bringing this to my attention, and Ben for kind of bouncing ideas back and forth and affirming what I'm seeing in the data with what you're seeing on the ground. But anyways, an uptick in cart supply when everything else was dropping. That was bringing it to kind of our attention. Looking into the data a little bit more, seeing a continual drop in prices until 2026. So the prices for a grain cart, I believe this is 900 to 1100 bushel grain carts, increased significantly so far into 2026. And the result of that is that they started to sit around for a whole lot longer. The days advertised percentage increased significantly over a year. And it's showing up across the country. I drive by my local dealership lot, and I think I counted 16 for a very small dealership out there the other day. And what I believe is happening here is carts are price elastic, meaning that they can be fixed or they can their new purchase can be delayed. You can make it work for another season. And a lot of them were purchased a couple of years ago when times were really good, especially if people upgraded their harvest equipment. Then it makes sense to also upgrade your capacity to pull it off a combine. So a few different things that are working against grain carts right there, and highly perceptible to brand switching. And I'm starting to see that more and more, even with high tech machines, tractors, and auto steer, that you can get converter kits. And so I think no piece of equipment is completely immune to that brand switching. And we're, like I showed you in the price piece, we're seeing a higher price point relative to the purchasing power. And even if your equipment is not increasing, we know that because of input costs, relative purchasing power is decreasing. And so it's a double whammy if your equipment prices are increasing while the farmer's pocketbook is getting skinnier. Where else are we seeing that? High speed discs is one of them. That's one area where the days advertised is increased even faster. And there's other examples of this equipment, and we'll kind of hit on that a little bit when we talk about days advertised increasing. But high speed discs was one of the first ones that popped up on a year over year increase on days advertised. Okay, again, to just show you real quick what we're going to be talking about, we're going to dive into combines first. So Class 8 combines, overall supply has been relatively steady, continues to drop and stabilize a little bit, down 16% year over year. We really took care of a lot of the oversupply in 2024. The biggest issue that I see with Class 8s are there's still a massive amount that are sitting under 1,000 SEP hours, or about 2/3 of the overall supply is sitting down in there. That makes that washout a little bit harder. It's not dissimilar from what we saw last year being these darker blue bars. And it is moving in the right direction where, 500 hours was the big slug of it last year. Now that's moved to 500 to 1,000 hours. So it is improving, but it is still heavily situated there under 1,000 hours. So it doesn't put it out of the worrisome camp quite yet. What is this doing to overall values, though? Auction market, I am seeing that down just about 9% year over year, down really 8% from this summer. But I see that more as a sign of a weakening of the equipment that's being brought to auction, that was really brought to auction in this second quarter, than a definitive drop in those auction values. Case in point, we didn't have a single Class 8 that went for more than $250,000 in May, and just very few so far in June. And so it's just, we're not seeing the quality of those machines hit auction, which is fine, but that does explain that downward drop a little bit. And I really think that the tightening supply that we're seeing in the overall market is helping to support those retail prices as we actually see that actual sold value, which is your dotted orange line, that is improving slightly year over year. And that's going to be one of the recurring themes that you're going to get sick of me hitting on. But actual sold data, I think this year has been more important than I've ever seen it before, partially because we don't have as much auction volume happening this year as we did a couple of years ago. And you want those real-time exact data points to help you make your decisions. And this shows a little bit of that margin improvement, whereas a year ago, actual sold was about 10% lower than list on average. And now we've seen that drop down to just 6.5% lower than list for these relatively low hour combines, sitting 250 to 1,500 hours. And that's my little filter down in the lower right. And as I move to a higher hour combine, 1,500 to 3,500 machine hours on these, relatively flat. Auctions got a little bit of support on these, and actual sold again started improving. Again, you're going to start to see that as a common theme on most of these categories. Where I think it's doing well is the actual sold values. If it has a substantial enough sale volume, which a lot of ours do, that those are doing strong. So that's up about 7% year over year. And when I dive in deep, I did it for utility tractors and combines. I went a little bit deeper into the data set. What you see here is just a depreciation curve. That orange line is the last 30 days of sales. There's been a few S780s that have sold here recently, and some really strong sales here recently. But this is in dealer sold. And so thus I said we had a lot of sales that have happened and come through actual sold. And they're showing some strong strength. So this is reflective to what we saw in the quarter over quarter trend graph that I showed you. Yeah, and really it's right there. We saw some great sales of S780 combines less than 1,200 hours. Again, if quick plug, if you are not submitting your sold data and getting sold data through TractorZoom Pro, I know I've got a ton of customers on here. Some aren't quite aware that it's just as easy as that. You do need this aspect. So reach out to your customer success manager and definitely get this, because this is, like I said, it's going to be essential this year as this market starts to move to have up-to-date information. Moving on to larger classes, class 9 and 10 combines, obviously a huge question mark out in the industry always of who's going to be the second owner of these. We haven't seen the supply drop considerably, just 5% year over year on these. The one bright spot that I am seeing, and new type of graph, I do love graphs, is this is just looking at your overall supply in terms of the age of supply. So your dark blue at the top is, it's only been sitting on the lot 0 to 30 days, and then you go 30 to 60. So it shows the kind of the pipeline of age until it all the way at the bottom gets down to 360 days plus, the aged category where you don't want to be. Biggest issue with class 9, 10 plus combines is that overall percent of age just sitting down at the bottom. It's really costly machines to have sitting around the lot for more than a year. So that is starting to come down a little bit in 2026. You see it decreasing ever so slightly. What is very concerning is that 90 to 240, kind of that green to red, that's a pretty big slug. And if we don't sell through that this summer, that will become aged around harvest time. And everybody on here knows the risk of, if you don't sell it this year, then it's going to be sitting around for 6 more months. So a true risk there potentially. Positive note though, in the 3 months of March, April, May, not huge combine selling seasons, I know, but we did see stronger sales volume year over year. One of the few groups. And honestly, I wasn't expecting it for these combines, but we did see that. And some of that was age that was moving. So there's some positive movement in these combines here just in the last few months. And the low hour stuff was moving as compared to last year. Okay, overall values. I'm not going to put a lot of stock into the overall auction just because there was 5 substantial sales that happened between 500 and 1,500 hours at auction. But again, the dealer actual sold, we had 36 that we had sold so far in 2026 of actual sales values, and they're showing stronger year over year sales in those. So again, just a plug for that. Data point you have to have this year. Okay, wrapping up on the combines, I will say class 7s, I looked at those as well. They mirror class 8s pretty tightly, so I didn't add those in addition to this. But lower hour units actually surprisingly brought fairly strong values at retail. Higher hour units a little bit softer, but okay. Class 9 combines, just still trying to find that footing, and there is a risk of a lot more becoming aged if they don't sell through this summer. Okay, really quickly, I hit on headers. And for the most part, I would have put headers in an actual fairly strong category. Both the supply of platform and row crop headers dropped 20 to 30%. That's positive. The turns are steady to maybe just a slightly weaker year over year, but not bad. Folding row crop headers, though, I do have some concerns on, and that's if I gave it a negative mark at all. That's why. Platform headers, like I said, down about 20% year over year. I look at turns on some of these, and roughly, again, spring is not a great time to sell headers, but I do look at those at troughs and compare those to prior years. It was platform headers were about 10% higher year over year than last year. That's positive, but the peak of 25 versus the 24 was certainly lower. So the downward trend is there. We'll see where we land this year. Hopefully not in the same trend. Row crop headers, though, we were more substantial on the supply reduction, 30% year over year. And then the turns actually pretty good. The trough turns was higher year over year, and at least the peak of 25 to 24 was just as high and more prolonged, which is substantial for moving more equipment for longer periods of time. So that moving in the right direction. And I saw a lot of strength with rigid row crop headers, 8 to 12 primarily, some 18, 16, 18 row, but mostly the 8 to 12 row. The challenge that I saw within this industry, and it came up time and time again when I was diving into some of the more popular models. Here, I specifically looked at Case IH's 4412 folding, John Deere's C12F, the 712 folding corn head, and then Drago's 1230F GT, combined all of those together, and in aggregate, the dealer list top value, the TL value, decreasing quarter over quarter, pretty much. Actual sold decreasing fairly consistently, except for some seasonality changes in there. And then at auction, not a lot of volume in there on these, but kind of sideways to the right. So relatively steadiness in the auction values, but challenges on the retail side for these. So again, folding corn heads, a challenge to look into those in your area a little bit more. I know there is some annual depreciation with those because we're not bringing as many into the fold to add new to that lot. But still, that was a fairly steep retail depreciation or decrease in value year over year. Let's get to tractors. Okay, starting a little bit smaller, utility, 100 to 174 horsepower. Overall drop in inventory about 30%. And this market honestly has been stronger than most over the years. Many thanks to the diversified buyers. Thanks again to our cattle farmers. But I think the cattle market is actually going to have a potentially a negative effect. It's been propping up utility tractors somewhat for a lot of dealers here for a while. But one important aspect within the cattle market is that unless you're a cow calf producer, now your input cost, if you're just buying feeder cattle and then finishing them, your feeder cattle are stupid expensive. And so that becomes a really risky business to invest that much money in one calf to finish them out. So it ties up cash, which obviously is not going to equipment then. And it just makes it more risky with the volatility of this market, especially the screw room variable that's in there now. So I think a lot of cattle producers that aren't cow calf are going to be in a more challenging place here, at least in the next 6 to 12 months going forward, at least in the United States. I think Canada is going to be in a better spot than we will. When I look at the overall utility market, positive thing is that the supply is becoming steady, and steady and consistency helps our industry out a whole lot. So that is a positive that we see across the top there. One of the things that's not positive and is certainly challenging, you have to be aware of, it hasn't shown up a lot yet, but it's that slug in the middle that you can kind of see those green to maroon colors. That will become aged here starting at the end of August and then all the way through December. If we don't sell a lot of utility tractors this summer, we're going to have a much larger aged utility tractor problem than we've had in years. And so certainly something to be watching out for. And also on utility tractors, I should say, I specifically narrowed this graph down to be just 0 to 1,500 hours. And so this is relatively low hour late model on these utility tractors. But as you think about what to do with these utility tractors, don't be afraid of auction. I've seen some very good auction values for utility tractors this year as opposed to last year. The light green here, and this is just a snapshot out of our Tractor Zoom Pro market trends piece. The light green is auction values on average in these buckets, 0 to 500, 500 to 1,000, that have happened this June compared to last June. And the graph all the way on the far left, that huge bar, there's some fantastic sales in there. So don't put a lot of stock that it's going to be that much larger, but it is strong. And it has been strong in almost every one of those hour segments as compared to last year. And just have the data before you go to auction, because and don't discount the auction, because I think there can be some bright spots out there for some of these utility tractors. On average, I'm seeing about at least 5 to 10% higher than last year. And real quick case study on John Deere 6 Series. Said it's going to go a little more in depth on utility and combines. Here's a look at what the sold market data is looking at. And this is sorted out for 6155Ms that have just sold in the last 3 months, that also include a loader. You can kind of get down to that level of detail, but it's obviously necessary if you're dealing with something with the loader and attachment. That the sold market average is not too far below the dealer list. And you can kind of see the delta on those auctions, not too far below that sold market average there. But this is if you click into the details within Tractor Zoom Pro, you can see the average dealer listing a couple years ago, 180, whereas now down to just shy of 170, and some of those auction points that have happened in there. So some of those auction values of even a 6 Series tractor here that's an old generation from John Deere have improved over time. But we're starting to see that retail price drop, especially since this is the last previous generation tractor. Okay, in summary on these utility tractors, overall, uh, I'm concerning. I'm watching it. I'm not too. It's not a fire sale yet. I just want to make sure that that's clear. But there are some things that we have to be watching, especially that aged inventory that is poised to resurge if we don't move enough this summer. And those auction values are strong and seem to be getting a little bit stronger. But that market that we've relied on with the cattle piece is probably going to weaken in our customer base. Okay, small row crop tractors, 175 to 300 horsepower. Supplies down about 26%. You'll see this supplies down pretty much everything. It's just a matter of how much we've been able to bring it down. Seeing a little bit, and this is one of the categories I thought was a little weaker than the larger row crop tractors, that the space between retail and actual sold is increasing a little bit, more so because the top line, the list price is going up. That actual sold value is just kind of staying steady. There's some downward pressure on that. And once you move up in hours, 2,000 to 4,000 hours, seeing a little more strength in the higher houred type of tractors, both at auction and certainly at retail. And I did a piece on farm equipment the time before the time. So I think this was back in April. But it discusses why this might be. And relatively, or in summary, there's strength, I think, within some of these higher hours at the row crop tractor market, because I think the buyers have shifted down a little bit and they're maybe a little more price sensitive. So they're buying higher hour stuff. One thing that we are seeing in some of the finer tuned data, this is looking at smaller row crop tractors, less than 2,000 hours. We're seeing a slowing in the velocity. And this, again, is a little bit of a summary of the farmequipment.com piece that I wrote, that typically less than 2,000 hours, we see about 38% sell in the first 60 days, typically. So far in 2026, we've only seen about 25% sell in the first 60 days. So the sales velocity of what's moving off the lot right away has decreased considerably, roughly by about a third, depending on the math you use there. But if you look at that section of tractors from 2,000 to 5,000 hours, that it's almost on par with what it has been historically, 53%, historically, and we're just shy of that at 46%. And so we're seeing continued strength and enough demand in those higher hour tractors, not so much in the low hour tractors. And that's going to be echoed here in the large row crop tractors. I'll show you a little table about that in a second. Overall supply in large row crop tractors has not dropped nearly as much, just down about 16% on those. And overall, with the supply that's out there, when I look at the actual aged, there's been a little bit of this uptick here in early 2026. Doesn't seem overly significant. But what that is actually showing, and what that's usually indicative of, is we're starting to see an increase in the amount of sales. And we saw it early, actually, November, December of 2026. So one of the first times that we've seen that in almost 2 years. A little bit of speculative buying on these larger row crop tractors across the country. Not a lot, but enough that it started to make an impact on the amount of new trades that we're getting in, especially in that, obviously it shows up in that 0 to 30 range there and pushes this proportion of those tractors higher. So that was a very healthy, positive sign to see that we're getting that increased trade activity within the industry. And the other thing that was positive to see is this is the amount of aged that we have on inventory lot here on the left. What is on the right is what is actually sold. And we're starting to see the amount of aged inventory that's sold exceed the amount, or the proportion of aged inventory that's sitting on the lots. You need to do that in order to decrease the amount of aged inventory that's out there. So if you're going to make a dent in it, essentially right-hand side has to be higher than left-hand side. And we're starting to see that with large row crop tractors. This is just really a snapshot from Farm Equipment article, but again, we'll send this out later. It does really show how much faster that these higher hour tractors are moving, especially 3,000 plus hours, than those lower hour tractors. This 16 or 14%, depending on your horsepower range, That's typically around 24% that we've seen historically. And from a value standpoint, list and auction averages are relatively flat year over year. We'll have more to come on some specific auctions. The real story again is this strength of actual sold. Really took a good jump here in Q2, but it has been steadily increasing really over the last 3 to 4 quarters. Now, I want to make sure, and I think I've said this before, but those are averages that are hitting. It's not necessarily volume. And so we're not necessarily going gangbusters on selling a lot of the tractors, but the ones that are selling are bringing, on average, fairly good values. Okay, quick case study on the beloved John Deere 8R 370s. God knows there's enough of them to do a study on. And not an insignificant amount has actually hit the market here over the past 2 months, especially the last couple of weeks. And so I don't know if anybody out there has also noticed this, but there have been a lot that are showing up, and multiple ones per auction that are going on. So looking at some of these within specific Tractor Zoom data, this is just showing the difference of these 8R 370s that were sold in the first half of 2025, 28 versus 45 sold at auction here just so far in 2026. So again, almost double the amount this year over last year. So something to be mindful of. I don't think, again, we're not going to see very many dealer sales that are going to completely liquidate, but we will see some inventory correction auctions. I don't know if any of these are part of that, but I imagine we will see more auction activity this summer to kind of right some ships that are out there. But really looking at the auction comps, there's some questions of why wouldn't you, at least for certain pieces of machines. With these 8R 370s, the auction values that were brought this year, this would be your red depreciation line sitting in the middle, is higher than 24 and 25. And the orange line, hopefully you're not colorblind, there's a lot of colors in here, that's even higher in the last 30 days than it has been earlier in 2026. So continued strength in some of those auction sales that we've seen here. So to summarize these large row crop tractors, inventory levels stabilizing. We're continuing to see the aged inventory decrease. We're not seeing an overall massive amount of decrease on the supply, but just a moderate amount. Auction volumes picking up, and the values, especially dealer sold values, are having very good support. Okay, one more on the tractor side before we wrap up with a little bit of planters, sprayers. High horsepower tractors, these, the supply is only down 14%. From a lot of the data I've seen, it probably needs to be more. The four-wheel drives continue to age on lot. And that's really why I say it, because this, here's your mark of what we've been selling through, and it is not yet to the point of the aged inventory that's out there. So we're helping to control it, but we're not reducing that amount of aged inventory. And these are expensive machines to have sitting around. And I think that's starting to show with the overall values. And I didn't year over year percentage these things out for you, but you can see the trend and where we're going in both retail list, actual sold, and auction values. One of the things I want to bring back up that we discussed earlier was elasticity of grain carts. It goes for all different types of machines, and some of the challenges or some of the things that make any kind of good more elastic, if they're durable, if they can be fixed or prolonged, if they're seen as discretionary, or again, if you can put off purchasing it, if it's considered quote unquote dumb machine, there's not a lot of tech that you have to upgrade with it, and the share of the budget relative to your purchasing power. And I think that's where a lot of these larger four-wheel drives come into question, because it is such a significant purchase relative to a tightening purse at the farmer's budget. So again, challenging scenario for some of the larger row crops, or for some of the larger ag equipment. Probably one of the more risky ones that I see out there. Self-propelled sprayers. Again, they aren't cheap either, but they're doing better. Certainly better than the four-wheel drives. Self-propelled sprayers down 28% in volume year over year. And as an overall amount, it's better than a year ago. The aged proportion, again, that's sitting over a year old, It's still a third of the overall used inventory, but that is down significantly from what it was a year ago. And as different than the utility tractors, your pipeline coming in that will be aged is relatively skinny, if you want to call it that. And so I don't think that we're going to see, or we don't have a lot of risk of this becoming more aged until much later. And so, healthier position for the self-propelled sprayers. Like I said, they're not relatively cheap. Year over year, you can track these things, and their average retail price has gone up considerably, but so has the value that they're providing, especially as more corn acreage gets put up. The benefit that they provide with fungicide spraying, that's all positive. The See and Spray and the vision technology that all the OEMs are putting out, positive. And again, you're seeing this here in this graph. Actual sold continues to spike up and pretty much mirror actual average list. So that's good. A slight decline on overall auction values, but what I am actually seeing at auction, I'm looking here at 500 to 1500 hours on these sprayers, is especially Deere, as they've come out with their newer generation of sprayers. The older generation, our 4038s, for example, are moving off of dealer lots. And then some of those find their way onto auction more often than not. And so it's just an older generation that's probably finding its way to auction more often than not. That's tailing that average down. Speaking of a not older generation machine, the 412Rs for Deere, plotting that here in a depreciation curve. Again, you can see 26 values, and even the last 30 days a little bit softer, but still much higher than your 2025 and certainly your 24 values. So some really good values actually that have taken place for dealer actual sold yet this year. So again, in summary, doing well with these self-propelled sprayers. There's a lot of support, and I think having that older generation kind of move off with a lot of this newer tech coming on, it does open up markets for farmers who have previously not been able to invest in this technology, that now they can. Maybe not the latest and greatest technology, but it does offer price points that they can enter into. Planters have been super interesting to follow because of the just massive decrease for so long on their overall supply, down 37% year over year. And really, these are one of the first pieces of large ag that started the decline on new orders. And so they've been going through this the longest. And I think one of the interesting repercussions of that is that now we might see the resurgence of new purchases happen first within planters. And I do believe we started to see the early indications of that here in end of May, beginning of June, with some early order periods. And we see it here with this uptick. I showed you an uptick earlier with row crop tractors, but this is relatively significant with planters, that we have 22% of the current inventory in June is just brand new, 0 to 30 days on lot, which is an indication that it's a new trade-in off of an existing sale. So positive there. And we continue to see that age to come down as we would, since we've been working on supply for so long. Average with planters, super hard. Like I avoid doing this as much as I can, but one of the reasons why I wanted to show this 24 row planters here from 2015 to current from manufacturing year, auction average, relatively steady, but it's really how well some of these actual sales performed in the second quarter of 2026. Just really strong sales. Again, the volume might not be there like it was 3 years ago, but the demand, I think, has been pent up long enough in certain areas that they're responding with some strong sales. But possible return to profitability in one of the early canary in the coal mine, if that's a positive. Light at the end of the tunnel is probably a better analogy to use on these guys. The deprived supply, I think, is returning some of that demand, and a lot of things are improving. The one thing I will say, I went down a huge rabbit hole on planters, and I started to see a lot of nuance within regions and brands with these of days on lot, what's moving, what's not moving. And your end gets pretty small once you get into that minute level of detail. But if anybody's really interested in planters and has specific questions, definitely reach out to me, because, yeah, it was a deep rabbit hole. Okay, round balers, and then I want to hit on some future factors here. And round balers, again, I've got a lot of data on this. I just want to hit on this real briefly, that we've been in a slower or a lower volume period for quite some time. Still 25% down year over year in overall supply, and really from an age category, I thought this was interesting that we have a perpetual amount of aged round balers that are always out there. And I looked across brands. This is not different from one brand to another. So entirely, I don't know what that is, but I thought it was interesting. But it has been a suppressed market. I think we're going to continue to follow the cattle herd size on these round balers for some time. Okay, last polling question before I hit on a couple things that I think we need to be paying attention to for the future. So your focus for the rest of 2026 and going into 27. Okay, again, a question that I asked this date last year. 54% were focused on selling more used last year. That's down now to 38%. The others were relatively evenly split last year with a little bit more on increasing efficiency. That part is down slightly, but it's really absorption is probably the biggest one that's increased, working on the parts and service. And that does make sense. And I mean, that's certainly what I'd suggest is we have less whole goods sales. And as your customer's equipment gets older, it certainly presents a lot of opportunity to increase your absorption. One thing I'm going to hit on, and I'll leave this up there. I also asked this question October 13th. So getting into Q4, selling used started to decrease. I wasn't sure if that was a trend or an anomaly, but it looks like it was more of a trend, which is good. We've been able to get the supply. It's good to see that those things are correlated, and absorption, that wasn't increasing yet. Okay. Okay, moving on. Last couple of slides here, just keeping in mind on, where we've been, where we're going. These couple pictures revolve a little bit more around tech. That's actually my dad standing on the combine there. But we've come a long ways in terms of what we're able to provide, and just can kind of imagine, or maybe it's hard to imagine, of what the future holds. It is certainly hard to predict, but exciting nonetheless. A few things that I want everybody to think about as they go forward. This kind of fits into the macro as well. That big news, was it yesterday? Today, housing bill was passed. Hopefully it does actually get passed or signed, but it's monumental, bipartisan effort. And this can have a significant impact on new home construction and new home starts. So new home construction, great opportunity for compact track loaders, mini X, or new home starts, highly correlated with compact tractors, residential turf type of equipment. So again, diversification, getting back to that. As long as this goes through, this will be a fairly significant move for our country and a good opportunity for people on this call. Again, pulling up something from Wes and his team at Meridian, that really just kind of puts in snapshot a lot of the challenges that the Iran war put into place. And I know we've got an open strait maybe now for a little while, but what this is really doing is it creates a lot of challenges and maybe some opportunities for our farmers, but you can start to see those input costs and the impact that issue is going to have on them. But certainly on the nitrogen heavy type of crops, as well as petroleum fuel. One other thing that trade disruption, the effect that has, and other things that are going around the world, Brazil needs a lot of nitrogen. Obviously, we do as well. Canada for wheat, us corn, but the safrinha crop in Brazil will be affected first. And that is getting to the point where if they don't get it soon enough, it'll actually significantly affect yields. And so that will be something to watch out for. Could boost the corn market slightly. We're obviously having horrible heat waves over in Europe, especially France. That's already diminished their crop production. Russia hit Odessa, and so that's going to diminish their grain exports. Again, it's not as big of a supply shock as what it was when the war actually started, but something to watch. And then obviously the challenges that Australia had with their wheat production this past year is supportive of the wheat market. So there's global things that are going on that are supportive for this overall market, and should be watching out for. I don't think any of them are quite black swans, but they can be beneficial. And so my big takeaway here is be poised and ready for your sales team and be having those calls, because I could see at the end of this year where there is some profitability in certain regions of the country that are ready to make equipment purchases because we've been deprived long enough with new demand, new sales, that some people are going to be ready to actually upgrade their equipment, especially because we have a much larger, broader safety net this year in terms of overall insurance. So start that sales process now to be helping your farmer out, either at the end of the summer or post harvest for sure. And again, like I said, I had so many graphs on here that I had to cut, made me feel like I had to pick a child as my favorite. So do me a favor, if you're not already on our email list, snapshot this thing. You can go to our website where you can sign up for the next webinar and scroll down a little bit and get on our email list. That way you actually get somebody that'll read all these graphs I had to cut, and we'll send you all that kind of stuff with our newsletter. I want to thank everybody for being here. If there's any questions, I left you a whole couple minutes, but I don't have anywhere to be for a while. So if anybody does have questions, you can ask them now. You can email me at that. A lot of you have my phone number. You can text me. And if none of those things happen, please come up to me the next time we see each other at a conference. Would love to chat with you. I think that's where I think we get some of the best insights and creative ideation of these what if conversations. And if nothing else, I can give you a call on my commute, and we can discuss what's going on in your neck of the woods and in the equipment market. So I'm going to leave this up here for a second. I'm going to breathe, and I want to thank everybody for joining us. And I hope to see you on the next webinar. Okay, somebody had a question. If I can, camera shifted here. If I can go into more on grain carts, and so I'll talk here for a little bit on grain carts. Kind of running off the top of my head without the graphs in front of me. Saw a significant amount of an increase in the days advertised, and then started looking into the overall inventory. Inventory was mounting up on dealership lots, and I know anecdotally and also through viewing that it's backing up on the manufacturer side as well. So first indication was an increase in supply, and then watching the dealer lot increase. And then diving into our valuation data, started to see within the different bushel categories, capacity of the grain carts, started to see the values increased significantly from 25 to 26. Now, I don't produce grain carts. I can maybe surmise that steel purchases, tariffs, things might have had something to do with that. I don't exactly know. But obviously, when you start to look at farmer behavior, and from our standpoint, from our farm, if we have to delay a purchase, it's a whole lot easier to delay a purchase of a grain cart, even if the flighting breaks or something we can pull and fix, repair, and have it last. And as opposed to maybe a tractor that might need to be upgraded for whatever reason. And so that gets into the elasticity that people are probably a little more price sensitive to grain carts when it gets closer to their ability to pay for it. And so I don't know if that goes deep enough into what you want for grain carts, but if you have specifics, I did look at a couple different make models. I saw kind of some similarities across make models. And so it seemed to be a broad issue that was affecting almost the entire industry with grain carts. And I've seen it in many parts of the country too. Next question. Same trend with tillage. Then yes. So with tillage specifically, I was looking at high-speed discs on there. And again, I got to give a shout out to Ben, because he and I were talking about this when we were talking about grain carts, and it was his idea to say, hey, look into high-speed discs. Now, the one difference I think that is potentially there with high-speed discs is that petroleum costs, diesel costs are much higher, and no-till and vertical tillage popularity is increasing. Whether chicken or the egg, I'm not entirely sure, but less passes over the field saves diesel. And so that could be hurting the tillage piece as well. But it also fits a lot of those characteristics of elasticity with grain carts. The price has increased over time, and it's easier to repair and make do with what you have. And then maybe the waning popularity of even vertical tillage and getting by without doing it, if that makes sense. And then I started looking into the actual data as well. Once we started to connect the dots, like all these different things are the same, looked at the days increased in days advertised, and it was it was shooting up high, faster than grain carts. And so I will tell you, I did a quick little AI search to our. We have a little Genie database that looks into all of our data. It's a quick way to kind of source it. It's not always perfect, but quick. And I said, what other categories also have increased a lot in price year over year? Which categories have uh, increased significantly in days advertised? And other ones that it came up with were smaller row crop tractors as one, and it also had to be a significant budget item. So I'm not looking for lawnmowers. Um, and yeah, smaller row crop tractors. I was not expecting it, but I am starting to see some cracks in that market right now. Um, and so I think that's the case. And then four-wheel drive tractors, I think, are at risk for it. I just haven't seen their days advertised increased as fast. They're already just high, so they're still high. Okay. Well, if there are no more questions, again, email me if you guys have questions. Now that I'm done with this webinar, I don't have anything to do for months. Yeah, shoot me questions. I hope to see you guys out and about. And if we can help you out with anything here at Tractor Zoom, don't hesitate to ask. Love those conversations and working with our partners. So with that, I will end it. Thank you all, and have a great summer.